Imagine waking up to a world where every number on the stock exchange is plummeting, yet some individuals are getting wealthier by the second. Crazy, right? But it's not just wild imagination, it's a strategic reality. Let's start by unraveling one major way fortunes are built during economic turmoil: short selling. In essence, it's like betting against the success of a stock. Investors borrow shares and sell them at the current price, anticipating that the stock's value will drop. When it does, they buy those shares back at the lower price, pocketing the difference. Another method? Options trading. More specifically, put options. By purchasing the right to sell stocks at a certain price in the future, investors can safeguard themselves against heavy losses, or even profit if the market crashes significantly. This works like insurance, but with potential for serious payoff when markets are volatile. So, who are the masterminds behind these strategies? Hedge funds and savvy investors with nerves of steel who see crashing markets not as disasters, but as landscapes teeming with opportunity. Those who understand these tactics can turn panic into profit with remarkable precision. But how do these investors anticipate what's coming? Enter the realm of data analytics and economic indicators. Before a crash becomes headline news, economists and financial analysts are busy studying trends, from employment rates to manufacturing output. These indicators often show red flags for those who know where to look. By identifying patterns and risks early, they position themselves ahead of the curve. Now, let's talk about another fascinating avenue: distressed assets. When companies struggle and their stock prices nosedive, they become ripe for the picking. Investors with deep pockets buy these undervalued stocks, believing in their long-term turnaround. It's like buying a beat-up car, fixing it up, and selling it for a profit. Patience and insight are key here, as turnaround may take years, but the rewards can justify the wait. And then there's diversification. The old adage, "Don't put all your eggs in one basket," rings truer during a crash. Spreading investments across various sectors, bonds, commodities, real estate, acts as a buffer. While one segment may lose value, others may gain or hold steady, effectively offsetting potential losses. These strategies transform chaos into calculated opportunities, where the astute can redefine wealth building by seeing potential where others see panic. While diversification is a protective shield, it's also about timing and adaptability. Let's zoom in on the role of automated trading algorithms. Yes, those highly intelligent, lightning-quick pieces of software can spot the tiniest opportunities amid market chaos far faster than any human can. These algorithms execute trades in milliseconds, adjusting positions as the market unfolds, maximizing gains, and minimizing losses with precision. But it's not just about being reactive. Being proactive is crucial. Investors study historical crash patterns, combining them with current market behaviors to model potential outcomes. By simulating different scenarios, they prepare strategies to either capitalize on or cushion against what's coming next. This foresight is like having a crystal ball that lets you peek into future market fluctuations. And finally, let's touch on the psychological edge. Successful investors maintain a clear head under pressure, leveraging fear and greed in the market to their advantage. They exhibit a contrarian mindset, often making moves against popular sentiment. If everyone is rushing to sell, they calmly look for buying opportunities. It's about mindset as much as strategy. So there you have it. Waves of volatility and economic downturns aren't just the end of financial stories. For some, they are just the beginning of new ventures and expanding fortunes. Now, let's shift gears and examine the role of geopolitical events in financial crashes. Global tensions, policy changes, or unexpected events like pandemics can trigger widespread panic, sending markets into a tailspin. However, those with a keen eye often see these disruptions as opportunities to pivot and reposition their portfolios for maximum gain. By staying updated with global news and understanding its potential impact on financial markets, investors can react swiftly, either by hedging risks or seizing new opportunities. Additionally, some see value in the area of mergers and acquisitions. During downturns, struggling companies become attractive targets for more robust firms looking to expand their reach or diversify their offerings at a discount. Savvy investors who back these mergers not only benefit from the immediate financial upside, but also from the long-term potential of a strengthened market position. Then, there's the pivot to cash. While the market fluctuates, maintaining liquidity allows investors to jump on opportunities that others might miss. By having cash on hand, they can purchase assets when prices are low without the need to sell at a loss elsewhere to free up funds. As we wrap up this section, it's crucial to underscore that while these strategies can lead to significant fortunes, they require meticulous planning, nerves of steel, and a deep understanding of market dynamics. It's not just about riding the wave of a crash, but steering the ship with foresight and strategy. Finally, let's consider the role of technology and innovation during financial downturns. Crisis often accelerates the need for new solutions, making it a fertile ground for tech startups and innovation-driven companies. Investors keen on spotting groundbreaking technologies, be it in renewable energy, fintech, or AI, can place their bets on what's next. These investments might initially seem risky, but during economic recoveries, they frequently pay off impressively. Moreover, as companies adapt to survive, the gig economy tends to soar. Platforms facilitating freelance work or remote collaborations see increased demand, presenting a dual opportunity: investing in such businesses and engaging talent that contributes to cost efficiency. And what about real estate? While property values might initially dip in a crash, the long-term trend has historically been upward. Those with the foresight to buy during the slump can benefit from significant gains as the market stabilizes and rebounds. This means not just scooping up residential properties, but looking at commercial and industrial spaces that businesses might offload in search of liquidity. Ultimately, these opportunities reveal a resilient truth. While financial crashes can be intimidating, they're also transformative, clearing the way for smart investors to strategize, innovate, and redefine what success looks like during tough times. So, what does all this mean for you? Crashes are not just financial annihilations. They're arenas of incredible opportunity for those equipped with the right mindset and tools. From strategic investments and embracing new tech to capitalizing on gig economy trends, the pathways to multiplying wealth are numerous. Now, what could be your next step? Subscribe to our channel for more insights that will empower your financial journey, and hit the bell icon so you don't miss a beat on tactics that could transform your strategy. Remember, knowledge is power, and you don't want to be left in the dark when the next big opportunity arises. Stay informed, stay ahead, and see you in the next video.